On May 6, 2010, the US stock market faced one of the most shocking and swift losses in its history. Within minutes, the Dow Jones Industrial Average plunged nearly 1,000 points, erasing roughly $1 trillion in value before rebounding almost as quickly. This incident, known as the flash crash, rattled investors and exposed vulnerabilities within the US financial system. Investigations traced part of the crash to an unexpected figure, Navinder Singh Sarao, a British trader with autism living modestly in his parents' home in London. Using custom software and a deep understanding of market behavior, Sarao made $40 million over 5 years, outsmarting high-frequency trading firms and revealing cracks in the system. Sometimes life is unfair. Being on the spectrum made him $40 million and me, I just make conversations weird. The flash crash wiped out nearly 9% of its value in minutes before recovering. During this brief yet chaotic period, some stocks crashed to a penny, while others spiked to 100,000, creating panic and confusion. At first, no clear cause was identified, no major news or economic event had occurred, but a series of factors, including a massive feature trade by a mutual fund and the behavior of high-frequency trading algorithms, was later found to have contributed to the crash. Central to this web was Sarao, whose spoofing tactics helped set off a cascade on these high-frequency trading firms. Their reliance on algorithms to make thousands of trades per second played a crucial role in the market's instability. The high-frequency trading firms use algorithms that analyze data and execute trades at speeds beyond human capability, adding liquidity but also heightening volatility when algorithms interact unpredictably. During the flash crash, these algorithms amplified price fluctuations and created this cascade of sell orders that quickly drove stock prices down and really underscored the potential dangers of relying on automated systems for trading. Sarao's role in the flash crash brought a new twist to the story. He's a self-taught trader with autism, and he executed a spoofing strategy from a single desktop in his suburban home. His approach involved placing large fake orders he never intended to execute, creating the illusion of high demand or supply. By immediately canceling these orders, he tricked the high-frequency trading algorithms into reacting to non-existent trades. Over a span of 5 years, he earned $40 million using this tactic. His actions largely went undetected and illustrated vulnerabilities in market oversight and the limitations of regulatory measures against sophisticated but small-scale manipulation. Market manipulation is illegal and it can take many forms, but in reality it's happening all the time, all around us, like jaywalking.
Objection, he's testifying. What I'm doing is winning.
It's important to realize that Sarao's strategy would likely have been less effective without the fact that there's all these high-frequency trading firms around. These high-frequency traders capitalize on small price differences, and they make thousands and thousands of trades per second in response to even the slightest of movements. Seconds matter. Milliseconds matter. The distance for the fiber optic cables matters. What Sarao's spoof orders created was a false perception of market momentum. It prompted these algorithms to buy and sell in response. This triggered a further feedback loop as algorithms began to react to each other, leading to a rapid decline in price. Sarao's tactic highlighted the fragility of markets dominated by automation, where minor disruptions can escalate into broader market stability. The flash crash led to increased scrutiny of both high-frequency trading and spoofing, and it prompted regulators to take a closer look at market manipulation tactics. The flash crash and Sarao's involvement revealed deeper concerns about the structure of modern financial markets. A key issue is the vulnerability introduced by high-frequency trading, where the decisions to trade are made by algorithms rather than human traders, And this rapid automated nature creates an environment where minor disruptions can spiral into these flash crashes. Another challenge is the capacity of regulatory bodies to oversee increasingly complex trading tactics like these algorithms or AI. It's interesting that Sarao's spoofing went undetected for years and that he made all this money before getting caught. It highlights a gap in traditional monitoring methods for high-tech and fast-paced markets. Although regulators have since implemented measures to curb spoofing, this story emphasizes the need for ongoing adaptability in regulatory practices to keep up with advancing technologies. Following the investigation of the U.S. Commodity and Futures Trading Commission, the CFTC, and the Securities Exchange Commission, the SEC, Sarao was arrested in 2015, facing charges of market manipulation and fraud. His case emphasized both the potential effectiveness and limitations of regulatory oversight. Though spoofing was technically illegal, it was largely undetected until the crash, showing how quickly trading strategies have outpaced regulatory measures, which is a very common occurrence these days, especially with AI.
Projections are by the time the company is mature,
1.4 billion.
Sarao ultimately pleaded guilty and forfeited his earnings, and the judge took into consideration his diagnosis and the fact that this wasn't a large conspiracy. It was just a small, local, non-institutional project. You know, he's an ethical hacker, if anything. Sarao's story serves as a stark reminder of the unpredictable nature of financial markets and the influence a single individual can wield.
Is that all you got?
Despite his modest resources and location, Sarao outmaneuvered some of the most advanced trading firms and impacted global markets. He was up against firms with the most high-tech technology and throwing millions of dollars into resources, and he beat them. The 2010 flash crash remains a pivotal event in financial history. It's a lesson in the fragility of markets dominated by high-frequency trading and automated systems.
You are a real troublemaker, Rhodes.
Runs in my blood.
After his case, there were developments of better systems for detecting market manipulation and new rules surrounding spoofing. But who knows what other shady stuff is going on right this moment that hasn't been caught yet. We'll see.